If you are like most people, when you think about financing of risky businesses, you imagine venture capital funds, well-capitalized institutions that input millions of dollars into potentially profitable but very risky ventures. These narratives are created by media that focus their coverage on large venture deals as one of the main things in the life of startups. What goes largely unnoticed underneath is the fact that power of these funds and their economic incentives makes them screw over founders and businesses with bad terms and bad governance practices. In this video, I am going to tell you how venture funds ruin businesses and show amazing alternatives that emerge in recent years. My friends, welcome to Stobox Insights, a video series about innovations in raising capital, law and finance, brought to you by a professional consulting company. We have dozens of videos on different methods and nuances of capital raising, so if you are interested in the topic, make sure to subscribe, turn on notifications and check out other videos. Let's go! The principal reason why founders have problems with Wall Street financing is the incentive of these companies and their business model. VCs usually invest in very risky ventures, of which at least 75% will fail, 20% will return at break-even, and only 5% will be profitable. This means that profitable investments should cover the cost of other failed ones. This is possible only in the case if profitable investments are sold at a huge profit, at least 20x to 30x compared to the initial investment value. This math can be illustrated by a simple example. Let's say that the fund invests 100 companies, giving each $1 million, and let's use the success rates above. Also, there are investors who want at least 10% annual return. Assuming 5 years towards the exit, the fund should return to investors around $160 million. Meanwhile, $75 million have been lost. $20 million return at break-even. This means that the remaining $5 million should cover 75 lost millions and return additional $60 million to provide profit to investors. This adds up to returning $140 millions, which is 28x multiple over the initial investment. Such an economics has two implications. Firstly, it means that the majority of businesses are not interested to VCs. At all because they are not able to grow this much. Such down-to-earth businesses should search for other sources of financing, one of which we will cover in this video, so stay until the end. Another implication is that dividend-based returns are not enough to VCs, and stable gradual growth doesn't work either. So they will push you to invest in growth as much as possible, even if this makes you unstable and creates the overall risk for a business. If you are not large enough to conduct an initial public offering, investors will push you to be acquired, even if you don't want, so that they could get returns. A case in point here is the legendary WeWork. The company rented properties and set up the offices there for gig workers and freelancers. Their economics was initially negative, i.e. WeWork lost money on each building. However, infused by the money from a venture firm Vision Fund, they beat all the competitors with better economics and have grown to a valuation of stunning $47 billion. Only when they were preparing for the IPO and did an initial disclosure of their financials, large public saw that the company was drastically overvalued and the valuation dropped to $2.9 billion, which is roughly the amount of cash they got as an investment. As a cherry on top, the founder of the company was fired from the position of a CEO. This is an example of the unbalanced growth and bad governance that can be created due to perverse incentives of venture firms. Please share with the community your thoughts in the comment section on whether VCs threaten or benefit businesses they invest in. Now let's discuss the specific clauses in venture term sheet that define power balance and are not less important than the valuation. Firstly, pay attention to the composition of the board of directors. It's very common for founders to not control the board already after the Series A financing. This means that investors have an indirect control over the company, because the board now can fire you and hire another CEO if they find it appropriate, which gives VCs power over the overall company direction, e.g. whether to focus on growth or profitability. Second common clause is a drag-along provision. It allows investors who jointly control enough preferred shares to initiate the sale of the company. Usually companies that acquire smaller ones demand to buy 100% of the company. The drag-along provision means that you may be forced to sell your stake if the company receives a lucrative acquisition offer. One of the most dangerous provisions is the so-called liquidation preference. It provides investors with a guarantee of return when the company is acquired. For example, if the investor has 3x participate in liquidation preference, it gets 200% of the initial investment at exit, and then additionally the share of the proceeds proportionally to the percentage of shares held. The danger of the liquidation preference is that you can get nothing if the company does not grow fast enough or is acquired at a lower value. For example, if an investor invests $1 million at a valuation of $2 million at 2x liquidation preference, and then the company is acquired at $2 million, the investor gets $2 million and you get nothing. Basically, instead of sharing the risk, the investor transfers it completely to you. If this video is insightful for you, please like it so that it gets higher exposure. Also, please share it with people in your network for whom it may be useful or entertaining. The reason why VCs can demand such a good terms is the high bargaining power. If there is nobody else to provide money and all VCs are in a similar position in terms of their economic incentives, there is no way for founders to get better terms. The way in which some founders get superior conditions is through the competition of funds. If your startup is hot enough and many VCs are competing for giving you money, you can enjoy some perks. Another opportunity is to use other fundraising methods with different economics. In particular, we at Stobox help companies with a security token offering. It allows you to raise capital from thousands of individual investors from around the world, providing a powerful alternative to VCs. As you're now negotiating with thousands of small investors and not one big, you're in a stronger relative position to set your own terms. Also, with security token offering, your shares now can be traded even before IPO, which provides investors with higher flexibility for exit and makes their incentives more aligned with yours. We have dozens of videos on different nuances of security token offering on this channel, so make sure to subscribe, turn on notifications and review them. If you are interested in getting a free consultation regarding how security token offering applies to your business, please contact me at bp@stobox.io. Stay tuned and see you in the next episode.